There is a manila folder sitting somewhere in Jennifer's living room in Charlotte, North Carolina. It has been sitting there since the spring of 2023, when her father passed away at 81 years old. Inside the folder is a letter from an IRA custodian. The letter says the account balance is $200,000. Jennifer's name is listed as the beneficiary. She remembered reading it and feeling two things at once: grief and something quieter underneath the grief that she did not quite want to name. Relief that her father had been careful, pride that he had built something worth leaving, and a sense that she had time. 10 years, the paperwork said. She did not need to rush. She was 57 years old, still teaching middle school. The money could sit. She would figure it out eventually. 18 months later, Jennifer made a decision that felt completely reasonable at the time. She withdrew $130,000 from the inherited IRA to pay off her mortgage. One large move, one clean slate, no more housing payment in retirement. She felt good about it. In early 2026, a notice arrived in her mailbox from Medicare. Her Part B premium for the year was $405.80 per month. Not the standard $202.90, nearly double. Based on income she had earned in 2024, she called her CPA. And in that one phone call, Jennifer learned 4 things that nobody had ever told her. 4 rules buried inside the account she had inherited, each one quietly compounding the damage of a decision she had already made. Here is what Jennifer's CPA explained. And here is what I want to make sure you understand before you make the same mistake, or before the deadline arrives, and you are left with only the years that remain. The first thing to understand is what the 10-year rule actually means. The 10-year rule, which is exactly what it sounds like, means that every dollar in that inherited account must be withdrawn within 10 years of the original owner's death. This rule applies to non-spouse beneficiaries who inherit a traditional IRA from someone who passed away after December 31st, 2019. If your parent, sibling, or anyone other than your spouse left you a traditional IRA in the last several years, you are almost certainly subject to this rule. Before this rule changed, beneficiaries could stretch withdrawals over their own lifetime, a strategy that allowed the money to keep growing for decades. That option is gone. The clock is running. Every year you do not plan as a year you are spending without knowing the cost. Jennifer assumed she had 10 years of flexibility. She was right about the 10 years. She was wrong about the flexibility. The fix here is simpler than it sounds. Find the paperwork for every inherited IRA you hold, or that you expect to receive, and write down the year the original owner passed away. Add 10 years. That is your absolute deadline. If you do not know whether annual withdrawals are also required, keep reading, because the answer depends on something most people have never heard of. The second thing, and the one that changed significantly in 2025, is the rule about annual required distributions inside that 10-year window. Under IRS regulations that took effect January of 2025, the rules depend on something called the required beginning date, the age at which your parent was legally required to start taking withdrawals from their own IRA. Under current law, that age is 73. Here is why it matters. If your parent had already reached 73 and begun their own required minimum distributions before they passed away, you, as the beneficiary, are now required to take annual withdrawals in years 1 through 9, and then empty the entire remaining balance by year 10. You do not have the option to wait until the final year and take it all at once. If your parent passed away before they reached their required beginning date, before they were legally required to start withdrawals, then you have more flexibility. No annual withdrawals are required, but the full balance must still be out by year 10. Jennifer's father was 81 when he died. He had been taking his own required distributions for several years. Under the new regulations, Jennifer was required to begin annual withdrawals from the inherited IRA starting in 2024, the year after her father's death. She did not know this. and the IRS does not send reminders. What to do about this before year end? Find out how old your parent was when they passed away, and whether they had already begun taking required minimum distributions from their own IRA. If they had, contact the IRA custodian this year, not next year, to confirm what your annual distribution requirement is. Missing a required annual withdrawal carries a penalty of 25% of the amount you should have taken. The third thing is the one that generated Jennifer's Medicare notice, and it is the part of this topic that most financial content never explains clearly. IRMAA stands for Income-Related Monthly Adjustment Amount. In plain terms, if your income exceeds a certain threshold, Medicare charges you more, not gradually, but in jumps. You cross a line by $1, and your monthly premium increases by a fixed amount. The jump is immediate. The calculation is based on your income from 2 years earlier. And here is the critical connection that most people miss. Every dollar you pull from an inherited traditional IRA is counted as ordinary income. It goes straight into what the IRS calls your Modified Adjusted Gross Income, or MAGI. And it is your MAGI that determines your IRMAA tier. In 2026, a single filer with MAGI at or below $109,000 pays the standard Medicare Part B premium of $202.90 per month. Cross that line, even by $1, and the premium jumps to $284.10. Cross $137,000, and it climbs to $405.80. Cross $163,000, and it reaches $527.50 per month. Jennifer's regular teaching salary was approximately $60,000 per year. When she withdrew $130,000 from the inherited IRA in 2024, her combined income pushed her MAGI to roughly $190,000. Her Medicare premium for 2026, calculated from her 2024 income 2 years earlier, was $405.80 per month. She had no idea the connection existed until the notice arrived. Here's the calculation worth running this week. Pull your most recent tax return and find your adjusted gross income. Add any income you have already taken or plan to take from an inherited IRA this year. That total gives you a rough estimate of your 2025 MAGI, which will determine your 2027 Medicare premium. If that number is approaching $109,000, you need to talk to a tax professional before you take another dollar from that account. The fourth thing Jennifer learned was that there are 3 ways most people handle inherited IRA withdrawals, and 2 of them are expensive. The first approach is what Jennifer did without planning to, taking a large lump sum in a single year. A $200,000 inherited IRA emptied in 1 year adds $200,000 to your taxable income in that year. Depending on your other income, this can push you into the highest federal tax brackets and trigger the highest IRMAA tiers simultaneously. This is the most expensive approach available, and it is the one most people default to simply because they did not plan. The second approach is equal annual installments, withdrawing the same amount each year for 10 years. For a $200,000 account with no growth, that is $20,000 per year. This is predictable and avoids the worst-case scenario, but it is rarely optimal because it does not account for your actual tax bracket in different years. The third approach, the one Jennifer's CPA introduced her to, is bracket filling. This means withdrawing enough each year to reach the top of your current tax bracket without crossing the IRMAA threshold. It is not the same amount every year. It changes based on your other income, your deductions, and the current IRMAA tiers. Done correctly, it is the most tax-efficient approach available, but it requires intentional planning every single year. The question to ask your CPA before the end of this tax year: what is my bracket filling withdrawal amount for this inherited IRA right now, given my current income and the IRMAA thresholds? Jennifer's CPA answered that question for her. Her teaching salary of $60,000 minus the standard deduction left her with room to withdraw approximately $25,000 to $30,000 per year from the inherited IRA while staying in the 22% federal tax bracket and keeping her MAGI below the first IRMAA threshold. She had room. She just had not known it existed, or that the alternative was going to cost her nearly $6,000 extra per year in Medicare premiums. The fifth thing is the one that surprises people who are also doing Roth conversions. If you are currently converting money from your traditional IRA into a Roth IRA, a strategy we covered in an earlier video, and you are also managing withdrawals from an inherited IRA, these two income streams interact. Every dollar you convert to Roth and every dollar you withdraw from the inherited account both count towards your MAGI in the same year. They both affect your IRMAA tier. They both affect how much of your Social Security benefit gets taxed if you are already receiving it. This does not mean you should stop Roth conversions. It means you cannot plan them in isolation. The year you inherit an IRA is a year where your entire income picture needs to be mapped before December 31st. The coordination of these two decisions in the same tax year is exactly the kind of calculation that a CPA or fee-only financial advisor can model in one conversation. And that conversation, done before year-end, is almost always worth more than its cost. For your specific inherited IRA, because the right withdrawal strategy depends entirely on your other income, your bracket, and whether your parent had already begun their own required distributions, a tax professional can run this for you in one sitting. Start here. Before you do anything else, make a list of every source of income you expect this year, your salary or pension, any Social Security you are receiving, any RMDs from your own retirement accounts, and the amount you are considering withdrawing from any inherited IRA. Add those numbers together. That combined figure tells you where you stand and whether you are approaching an IRMAA cliff that you still have time to avoid. Jennifer learned all of this too late to undo year one. The $130,000 she withdrew in 2024 has already been counted. Her 2026 Medicare premium has already been calculated. That year is closed. But she did something with what her CPA told her. She mapped out the remaining 9 years. She calculated a withdrawal plan that keeps her MAGI below the first IRMAA threshold every year for the rest of the window. She will pay more in taxes on the inherited IRA than she needed to in year one. That cannot be changed. But she will not overpay again. The damage from year one is permanent. The plan for years 2 through 10 is still entirely hers. Here is what all of this adds up to. The inherited IRA your parent left you is not simply an account. It is a 10-year tax decision, and inside that decision are at least 4 distinct rules that interact with your Medicare premium, your Social Security taxation, your federal tax bracket, and any Roth conversions you are making simultaneously. The 10-year rule sets the outer boundary. The required beginning date determines whether you have annual withdrawal requirements inside that boundary. The IRMAA lookback means the tax decisions you make today will affect your Medicare bill 2 years from now. And the bracket filling strategy is the tool that lets you work through the full 10 years at the lowest possible combined cost. None of these rules are complicated once you understand them. All of them are expensive when you discover them after the fact. The inherited IRA sitting in your name right now is not just an account. It is a 10-year tax decision, and every year you delay planning is a year you cannot take back. If this video helped you see an inherited IRA differently, subscribe so you do not miss the next one. Every week on this channel, we cover the retirement decisions that arrive without warning, the rules that were never explained to you, the deadlines that do not send reminders, and the costs that show up 2 years after you made the choice that triggered them. The best time to understand any of these is before the notice arrives in your mailbox.